Austan Goolsbee joins us now, Chicago Federal Reserve President. Austan, thanks for joining us.
Yeah, great to see you, Steve.
So I don't know if you were listening to the last two guests. You got to be listening to Squawk to pay attention to what's going on in the world today. We had Jeremy Siegel on arguing that the market-based surveys of inflation are down or negative, and you can cut all you want. It's not exactly what he said. But then we just had a gentleman on who's making screws and fasteners and all kinds of things, raising his price because of the tariff. So tell me how you balance this as a policymaker, this idea there is not really long-term expectations out of control, but you have people raising prices. What's the right call on policy in that context?
I saw both the segments, and the fastener Dan, he's more like my people out here in the 7th District, which is heart of the Midwest and where the manufacturers are. I think that highlights the dynamic that we've got short-run expectations about inflation going up, and people are expressing fear that we're going back to a kind of a 21 or 22 environment where prices are getting too high and inflation is starting to rage a little out of control. But the core long-run expectations not rising, at least in the market variance, I think that's a very important fact. And if you listened closely to what Dan was saying about the fasteners, there was a lot to like about it, in the sense that he was talking about substitutability and adjustment and ways that they could redo the supply chain to get away from some of the worst impacts of the tariff. The more action like that takes place in the private sector, the less impactful tariffs would be on disrupting the supply chain.
So can you cut preemptively to address potential economic weakness?
Look, everything's always on the table, as I say. It's a huge table. But the Fed is supposed to be the steady hand here. What we need to do is look through, get the through line and where are things going to be, let's call it after the 90-day pause and going through the year. Tariffs are one input. They're one shock that happens to the economy, but conditions change all the time. We've got the productivity growth rate has been surprisingly and lovely, in a lovely way, been very strong for a couple of years. I would definitely want us to get a bead on whether tariffs or supply chain disruptions are affecting productivity growth. And we just need to see. Most of the U.S. economy is domestically driven, as you know. At the end of the day, imported goods are only 11% of GDP. So unless it jumps out of just its own 11% lane, the impact of tariffs on the macroeconomy could potentially be modest. Now, when I'm out here in the Midwest and we at the Chicago Fed are talking to people, we're the most affected district by tariffs because we're the most manufacturing oriented. And folks have been saying for months that they were nervous about what potential impact would be if the tariffs were too big, that it would kind of throw us back to the 21, 22 period or even back to the COVID supply disruptions. I kind of think the through line is we've got to get our way through this. You know, out here, if the storm signal goes off, people know go down in the basement and wait it out. And that's kind of writ large onto the economy. That wait it out impulse is the thing that we've just got to get through to figure out what to do.
Austan, the dollar has been a little weaker, bonds a little weaker as well. Does it matter that the president is talking about the potential to terminate the Fed chair?
Look, I'm not going to get into the discussion on that. I know the secretary, I agree with the Secretary of the Treasury when he said Fed independence is a jewel box that we don't want to mess with. All economists, I've been at the Fed for a little over 2 years. Before I was ever at the Fed, I would tell you, economists are basically unanimous that Fed independence is critically important. And to see why, just look at the countries where they don't have Fed independence. Inflation is higher, unemployment is higher, growth is worse. So I think there's a lot of back and forth that is outside the purview of what the Fed, in my opinion, should be doing is following its legal mandate. Stabilize prices, maximize employment, and it is the conditions that determine what Fed action are, not anything else.
Mr. President, the recent numbers that if I just were to immediately say, wow, this number matters, it looks to me like inflation is less of a worry right now than a slowdown. Tariffs can cause both. I'm more worried about tariffs causing uncertainty, which becomes self-fulfilling with corporations, and that we really get a possibility of a slowdown. I don't know about a recession. And then on the inflation side, it just seems like a one-shot deal unless there's we get into a tit for tat. It's the second derivative. It's not like the inflation we had 3 years ago. It's not the same. So I think the risks are not equal now for the dual mandate. And that's why I think you believe this in your heart. It'd be nice to preempt the slowdown because these last inflation numbers we got were pretty tame.
I don't know if I didn't have my coffee or what happened. But most of what you said, Joe, I totally agreed with.
That's what I mean.
I don't know what's happening to me.
Because you are MAGA Austan now.
So, look, I agree that if you get into the difficult part of a scenario for a central bank is if both sides of the mandate start going wrong at the same time.
Right.
If
but I think
the inflation side does not start going wrong, then
what's more likely right now? Seems like the slowdown is a bigger risk to me.
It might be, but then it's also about magnitude. So if you started to see inflation going wrong and unemployment going wrong, let's say, right. A, you would want to know how long is it going to last, and B, you would want to know, well, how much is it getting out of whack on one versus the other. If it was a theoretically pure tariff, let's call it, one-time increase in the price, no retaliation, no follow-up increases, very little in the way of supply chain disruption, then I agree with you. That's a transitory inflation shock. And I've been saying for a long time, if you could just keep it kind of in its lane, most of the U.S. economy is domestically driven, is not dependent on tariffs. I think our uncertainties at this moment and why for me personally, when I hear Jeremy saying preemptive cuts, we're getting announced retaliation. We're talking about revisiting the tariffs in 90 days, and we don't know what the impact on the supply chain is going to be. So I think we want to be a little more the steady hand and trying to figure out the through line before we're jumping to action.
Austan, you point out that your district is the one that is the manufacturing hub of the United States. You feel these things more deeply. Do you think that the tariffs can do what the president has laid out as a goal, which is to reinvigorate manufacturing, particularly in the Midwest? Do you see that happening?
That's a longer run effort, and I applaud the effort that if we're going to increase manufacturing, it partly depends how this negotiation chain with other countries is going to go. You saw the Secretary of the Treasury say that he thought when this period was over, it was going to reintroduce, he called it the golden age of global trade. If on the back end of this we got new agreements and the productivity growth remained high, I think you could see a rebound of manufacturing for sure. In the short run...
Oh, sorry, go ahead.
Yeah, I was just going to give the example of steel, where we put in tariffs on steel, which you would think would be fostering the domestic production of steel, but you've seen a series of domestic steel producers actually start some layoffs because the demand is not there, because the tariffs are hurting their customers more than they're helping their cost side.
Austan, I wanted to ask you a separate question. You referenced Scott Bessent a couple of times now, once talking about the independence of the Fed, another in the context now of tariffs. But a different reference would be prior to President Trump's election, he talked about putting in place effectively a shadow Fed chair, or at least nominating somebody, naming somebody early, and that this idea that somehow the market would look through it. This was his proposal, not somebody else's. Of course, now he has to deal with Jay Powell every
he's
week.
Kind of backed off it, right?
I know he's backed off of it, but he's the one who introduced it. And so the question, though, now is, given that the president is back to the idea of terminating the Fed chair, whether you think there's a possibility that you would nominate or that he could nominate somebody early, and what do you think that does in terms of the way the bond market behaves?
It sounds like you're asking for political scenario analysis from a guy with an econ PhD.
No, it's not a political scenario. No.
It's
let's say there was somebody that was announced in the fall, and that person was sort of known to be dovish, if that's what the president wanted. Do you think that it's possible that the bond market or bond investors would, quote unquote, look through whoever is there in the interim to somehow get to the other side? It's not a political question.
I would ask you know far more about what bondholders and investors' sentiment is than I do. I'm just down here trying to fulfill the dual mandate, voting on stabilizing prices and maximizing employment. I don't want to get into all the machinations that you're describing. Jay Powell is a Fed chair. I'm a strong supporter of the FOMC. As sitting at the table, I can tell you it's my opinion that is now the world's greatest deliberative body.
One just real quick follow-up, which is, how important is the Fed chair themselves to the conversations you have at that table? Meaning, if somebody walks in the door and is extremely dovish or is extremely hawkish, and they are running that meeting, that ultimately would be the outcome.
Well, I mean, it's a vote, but the chair is by far the most important person sitting around the table, and their opinion carries a lot of weight. I think that's been hard earned from Volcker forward. You've seen the chairs express their opinion and maintain credibility. So whoever is the Fed chair, I imagine, is going to be a strong name and somebody that will carry weight for sure.
Right. But, Austan, I wonder if it might be worth to look at the real reasons for Fed independence, which is nothing to do really with the short-term call you make, because you guys, you get it right sometimes and you get it wrong sometimes, and maybe the president knows exactly what the right interest rate ought to be right now. But isn't there a long-term issue here in terms of how Fed independence underpins the value of the dollar and the value of the whole bond market, in that if you get it wrong, you're going to correct yourself either way? Whereas if you are subservient to an administration, and this is not theoretical, because we went through these bouts in the 70s where the Fed got it wrong and didn't correct itself until somebody else was appointed and came in. So isn't that really the issue, is the long-term credibility of the Fed, not the way it operates within a cycle?
Yeah, probably. I mean, for the most part, and I think that's a different way of explaining why we tend to look at long-run inflation expectations. And the fact that when short-run inflation was almost double digits a few years ago, but the long-run expectations that the Fed would get inflation back down to the 2% target were critically important. Fed independence is critically important for that. As you know, Paul Volcker was a dear friend of mine, and his widow, when he died, gave me that original 2x4 that they mailed to him that says, please lower these insane interest rates. And I keep that on the shelf right next to my desk to remind me, A, when we go to the FOMC meeting, it affects the real economy, but B, sometimes the Fed has to do the hard job. And that's, if you look around the world, the reason why in countries where there is not Fed independence or central bank independence, the inflation rate is higher, is because when there is interference over the long run, it's going to mean higher inflation. It's going to mean worse growth and higher unemployment, because there's just going to be a little less willingness to step up and do the hard things when the moment is tough.
Austan, do you like the new Austin, I mean, is it a better place not talking? I mean, we used to talk politics all the time, and you loved it, and you loved it, and you were so ready.
I grudgingly accepted your terms, Joe.
When you stop doing what you're doing now, are you going back to the old, or are you like St. Paul? Are you different? You get knocked off a horse, and you just are just totally.
Did Joe just say I'm like a saint? Joe just said I was like a saint. I'm impressed, Joe.
You know that story? I think he was Saul before
I know
that or something.
Hey, just real quick, Austin, you had said before.
He didn't answer.
Yeah, I know. I'm bailing him out, I guess. Austin, real quick, you
I
had
think he
said
likes the
previously
new
that
Austin better.
That you think that rates 12 to 18 months from now will be lower from where they are today. Are you sticking with that?
I still think that because I think we're going to get through. There's a lot of noise, a lot of dust in the air. But at the fundamentally coming into April, we had unemployment right around 4%, which is pretty much stable full employment, and inflation was in the mid-2s and coming down. And if we can just get back on that path, I think that the long-run settling point for rates, you can see in the dot plot, is well below where we are today. So I think we're going to get through the noise and can get back on that.
Austin, thanks so much for joining us this morning.
Yeah, it's great to see you guys again.
Austan Goolsbee.
Mr. President.